Good morning from London. I'm Anna Edwards alongside Guy Johnson and Lizzie Burden. We're an hour away from the opening trade. Here's what you need to know. US tech stocks rebound from a sell-off earlier this week. Attention now turns to today's Fed decision and US megacap earnings. ASML's fourth quarter orders smash estimates as the AI boom drives demand for its advanced chip-making machines. Plus, LVMH sales fall as customers tighten their purse strings, casting doubt on a luxury rebound.
We're checking in on these markets, and things have calmed somewhat after the Monday turmoil. You've got futures pointing higher at 0.1% on Wall Street after we look towards these mega cap earnings, a raft of them that we'll get later on today. ASML earnings beating across the board, that boosting European stock futures. We have the 10-year US Treasury yield at 4.5% ahead of the Fed decision later. Bets ramping up about a March cut, and we'll listen in particularly to Powell's comments at the presser. We've got euro dollar at a 104 handle ahead of that ECB meeting in Frankfurt. The countdown to the opening trade starts right now.
Wednesday morning, good morning. I don't want to raise expectations, but today is a really huge day. There is so much going on. There is so much that you're going to have to watch. You're going to need 4 screens, 5 screens in front of you just to figure out exactly what is happening. You've got the Fed. Obviously, that's going to be a massive event. Is it, though? We'll talk about that in just a moment. You've also got 3 of the mega caps in the tech universe reporting numbers. Tesla's going to be out with figures. Microsoft is going to be out with figures. Meta is going to be out with figures. We have already had ASML here in Europe. And then, of course, we come to the football. It is a night of chaos in the Champions League. What are you going to watch? The Fed press conference? Or are you going to watch the football? It is going to be a big night, I suspect, for everybody. Let's start with what is happening with the earnings picture and the tech rebound.
You raised my expectations until you mentioned the football guy. But anyway,
football's going to be big.
We'll park that one for now. Let's talk about tech, shall we? Because we are looking ahead to those tech earnings. We had a rebound on Wall Street yesterday in the tech sector, and we can show the 2-day performance. And actually, you know, not too bad when you look across at things other than Nvidia, the rest of the tech sector even not doing too badly. So that's the story. And then we overlay the latest on DeepSeek, which is just fascinating. So Microsoft and OpenAI, they've opened an inquiry, a probe into possibly unauthorized access of OpenAI by DeepSeek. Does this mean that DeepSeek was acting as a kind of student model, latching into the parent model, OpenAI, and using the technology of others in that way? Which raises the question we were asking yesterday. The fact that US tech came out and congratulated them so quickly, should we take that as, you know, they know that this is technology that is as good as it says it is? Or do we need to wait, as Richard Windsor advised us earlier this week, wait for the actual tests to be done?
Yeah, it's interesting that there's a note from BI's Robert Lee, who, of course, has been all across the DeepSeek story for months and months, but talking about a possible US ban on DeepSeek, not ruling that out. And then you hear the statement from Trump's AI czar, David Sachs, saying that there is substantial evidence that DeepSeek lent on OpenAI. So, you know, you say about this warm welcome in terms of competition when DeepSeek first came, the news first came, but actually, do we see a reversal?
Does it matter, though? Does it matter? Does it matter if they've lent on the model? Let's assume that you're going to have a series of really high-end models and everybody else is going to lean on them. If we want to democratise AI, don't you just need a series of cheap models that kind of in some ways maybe do piggyback off the big models?
Right, maybe, but doesn't it? But it changes how much you allow each business at which point in the supply chain to spend on the technology, I suppose, doesn't it? If you're bringing the cost down. Do
you need a lot of high-end models? I guess is the question that I'm asking, which will take us to ASML in just a moment, on whether or not we're getting to peak capex, and whether or not actually you need to spend all of this money to deliver a series of very high-end models, some of which may or may not be winners, or do you actually need to have a series of lower-end models which actually allow other businesses, to use this usefully? Yeah, I mean, US big tech still putting astronomical figures out there in terms of the amount of capex. Certainly we heard that from Meta last week. Lizzie, we've had numbers out of ASML this morning, adding to the European angle on the tech story.
Yeah, beats across the board, a record year, a record quarter, bookings twice estimates, and AI the driver. So relief after the DeepSeek
But is this peak numbers? Is this peak capex? Because if it is, it'll take a while to get through to ASML, but nevertheless, in some ways, this is the kind of as good as it gets for the AI narrative. Maybe you just need a series of lower-end chips. You don't need the higher-end chips, the super high-end stuff that ASML is super good at.
Yeah.
Is this where we are in terms of this journey? I thought yesterday's bounce back was fascinating in terms of the big tech stocks. Clearly there is money that wants to come in and buy these businesses at a lower valuation. But is this a head fake? I think is the question that a lot of people, I think, will be asking. Portfolio managers will be sitting down going, is this a head fake? You get earnings, say one of these big companies comes out and says, actually, we're going to start scaling back our spend from here. This is as good as it gets. Is yesterday's trading a reflection of that, or is that the bad news still to come? Do we need to suck in that extra little bit of money before actually you see the downdraft, the full downdraft in tech?
Well, we will see. And nothing we heard from ASML this morning told us anything about the DeepSeek story, did it? It told us that the fourth quarter was really strong, and they have upgraded in the short term their guidance around the first quarter. So, and it comes at a time when the market has been selling tech stocks, certainly the beginning of the week, and so perhaps it's falling onto ears that want to hear positivity around European tech. Just a quick word on LVMH as we go through these earnings reports. This came in contrast to the Richemont numbers. Richemont on the 16th of January, a really strong story, setting up the stage for strong performance in the United States, and we didn't quite see that out of LVMH, and as a result that could be an issue. This is a business though that relies for a quarter of its revenues on the US, and all accounts from Arnault, as he was in the US for the inauguration, are that the US economy is really booming.
Yeah, Burberry as well had that pickup in US demand. I wonder if the reason that Arnault is so confident about the outlook for the US is because of his relationship with Donald Trump, which we know goes back so long, hence why he was at the inauguration. But I do think that fashion often gives us an indicator of the economy. And if you look at the outfits, Melania Trump wore Dior on election day and over the inauguration weekend. Ivanka wore Dior and Givenchy over the inauguration period. So perhaps it's a sign that there'll be easier tariffs on European luxury. Is that too much of a stretch?
I'll talk about the football, you talk about the fashion. I thought the outlook statement from LVMH was actually quite positive. So I think, yes, the numbers are disappointing. So I'm really intrigued to see. Yes, we'd like to see a drop at the get-go of trade this morning, but how long that lasts for. The Fed, we need to talk about that a little bit later on. Obviously, that's going to be something that we're going to watch a little bit later on this evening. Gunlach says this is a highly predictable non-event, basically. Meh. Meh is, I love that word. But I think the market is looking to see whether March is live. And I think that's the trade today, to see whether or not that next meeting coming up is something we need to pay attention to.
Are the clues from the bond market a little confused by the fact we had that tech sell-off and then there was a surge into the perceived safety of bond markets as a result? But that to one side, it does seem as if the bond markets are sending a signal that they're increasingly thinking about a March cut. So any confirmation or pushback against that expectation from Powell will no doubt be the headline.
Yeah, I think they're pressing about a 30% chance of a March cut. But all of this is going to be incredibly disappointing for Donald Trump if it's just a hold today. Think of all the pressure.
I just don't think the press conference will be meh. If you've got a president who wants rate cuts and who thinks he knows more about interest rate policy than the chair of the Federal Reserve, that provides the stage for puts tension there.
So that's 7:30 this evening. You've got the City Bruges game kicking off at 8. You've probably got Trump live tweeting, live posting during the press conference with Powell. This is what I mean. You're going to have multiple screens today. You want to watch the football, you're going to watch Powell, and you want to watch what Trump is saying all at the same time, basically. A little bit later on this evening. It's going to be a little late.
It's getting
for us.
very late, yeah.
After our bedtime.
That's all I'm thinking.
Definitely after our bedtime. Abigail Watt's going to be joining us very shortly. We'll set you up for that Fed decision a little bit later on. Is it going to be Mayor? She joins us from UBS. Alison Porter, Janice Henderson, portfolio manager, tech expert, joining us later to discuss the bounce we saw yesterday and the earnings that are still to come. And Diane Coyle, University of Cambridge, Professor of Public Policy, setting us up for a big speech in Oxfordshire a little bit later on from Rachel Reeves.
Indeed, the UK Chancellor of the Exchequer building on Keir Starmer yesterday, talking about growth. And at 2:45 p.m. we'll have the Bank of Canada rate decision, 7 p.m. the Fed decision, 7:30 p.m. Powell's press conference, and aftermarket, all of those earnings from Tesla, Microsoft and Meta. I've got a close eye on the Reeves speech. Yesterday I was talking to the former boss of Tesco, Dave Lewis, and he was saying, you can't talk your way to growth. We need to hear some policy here from Reeves.
Although talking about it is maybe a step in the right direction, given the response we saw from the budget. Yeah, exactly, and they were accused of being too gloomy. So now we've got the talk. Do we get the action? I mean, the Oxford-Cambridge arc, that seems to be something we're watching for. Runways at airports are sorted, dividing the cabinet, that's also something we're watching for.
Yeah, how the politics plays out around this is going to be amazing. But there does seem to be at least a motivation to lean in on what the good growth, or what the UK is good at. which I think is interesting. Life sciences, AI could be another area, linking up Oxford, Cambridge, London. You've got three fantastic universities, London, Cambridge, Imperial, Oxford, Cambridge, Imperial, in that triangle. Kind of what happens with that, I think, is going to be really interesting to watch. The politics around it, though, can she deliver on it, I think is the other big question. How far can they really go in terms of planning policy, making sure that the infrastructure is actually ready? If you talk to anybody in Cambridge, it's really hard to build there.
Yeah, it's all well and good building houses, but you've got to build the transport to go with it.
Exactly. Schools, hospitals, all this other kind of stuff.
You've got to sort the electricity and the water supply, which has proven to be an issue in that particular area.
And, it's all well and good having the industries there, the universities there, but can you get the salaries? You've got the non-dom rules, you've got our tax system compared to the US system, the salaries alone. Can you get the talent?
But there is again, you talk to people in Cambridge, and Oxford, there's a shortage of lab space, there's a shortage of all the kind of things. How growth constrained are some of those areas in the UK at the moment by the infrastructure or the lack of infrastructure available to do what we want to do? Let's talk about some of the other stories that we're watching. We'll bring you that a little bit later on, that Reeves speech. It's going to be a chaotic night, as we've already been mentioning, for European football. 18 Champions League matches will be played this evening as the first part of UEFA's new format for the competition comes to a dramatic conclusion. Some of the wealthiest teams in Europe, Manchester City, Paris Saint-Germain, risk being ejected from the tournament tonight. Bloomberg has learned that Apple has secretly been working with SpaceX and T-Mobile US to add support for the Starlink network to its latest iPhone software. In an under-the-radar move, the smartphone's latest software update, released this week, now supports the technology. The initial version of Starlink is exclusively for texting, but SpaceX and T-Mobile have previously said they plan to expand into data connections and voice calls in the future. And a federal judge has temporarily blocked the Trump administration from enforcing a directive to hold payments to federal grants and loans, sparking panic, I have to say, over the last 24 hours in Washington. The ban, not the judge. The White House defended the new measures.
Again, I would say this is not a ban. This is a temporary pause and a freeze to ensure that all of the money going out from Washington, D.C. is in line with the president's agenda. And as the Office of Management and Budget has updates on what will be kickstarted once again, I will provide those to you.
Caroline Levitt's first press conference, youngest ever press secretary. Probably worth pointing that out as well. They're going to open the room up a little bit too to other forms of media. Back to the saga, obviously, around spending. It has sparked a significant debate over the executive branch's power to control federal spending, with some Republicans supporting Trump's actions. Democrats, of course, calling it unconstitutional.
Those are some of the stories, then, that we are across this morning. Now, leaders in the world of private equity are meeting at the EPEM conference in Cannes. Bloomberg's Kriti Gupta joins us there from Cannes. We were just covering a host of stories, including some US politics, Kriti, and there's a lot of expectation, I'm sure, where you are, that perhaps we get more deal activity under a Trump administration. What else is on the agenda?
Yeah, Anna, that is the exact vibe that you are getting here. The idea that even though the regulatory environment might be tougher in Europe, the spillover effect from the states and that deregulatory agenda from the Trump administration may actually be a positive thing for PE firms operating right here in Europe. In addition to that, we're talking about mobilizing trillions of dollars that are really wrapped up in institutional and generational wealth right here in Europe, and specifically in the southern part of France as well. So we're going to talk to the major players out of KKR, Apollo, Ardian, and many, many others, really talking about just how you can not only mobilize that wealth, but also democratize it so that your everyday kind of consumer can also get in on what's turning out to be a very transformational period for Europe as a whole when it comes to defense, AI, etc. We're going to talk to the folks making that transition possible.
Kriti, thank you. Lots more with Kriti Gupta at the EPEM conference as we go through the morning live from Cannes. Coming up on the programme, we hear from the EU Financial Services Commissioner getting her view on the future of banking consolidation on the continent. We are talking about competitiveness. We're talking about the Capital Markets Union. Will we finally make progress on that agenda? Plus, drinks maker Remy Cointreau. Sales hit the low end of guidance for this business. We'll check in on that stock as it opens. Up next, traders turn to the Fed for clues on future rate cuts. We'll discuss the outlook. A lot of focus then on any commentary around March and whether we get a rate cut in March. And of course, Powell's latest thinking around the Trump agenda. If you have questions, if you want to get in touch with the team, IB plus BBTV Go. That is the function to use on the Bloomberg terminal. This is Bloomberg.
41 minutes until the opening trade. European futures fairly mixed. The Stoxx 50 up by around 0.7%. There are many, many things that are going to cause chaos in this market, one of which is certainly going to be the Fed today. You've also got a series of earnings coming through from big tech. That's certainly going to be something to focus on. But let's talk a little bit about what we're expecting from Jay Powell and co. a little bit later on. 7 p.m. UK time is when we're going to get the decision. Obviously, the press conference today, I think, probably is going to be the main event. Are we going to leave the door open to a March cut? That is what the market is trying to figure out today. Abigail Watt, US economist at UBS, joining us around the table to discuss. Is that what we should be looking for?
Yeah, so I think you're totally right. As we look ahead to the Fed today, I think, there's no expectations for changes in policy. There's no summary of economic projections for us to look out for. So I think there's going to be a lot of attention and focus on the comments from Chair Powell. And I think there's going to be two key areas that we're listening out for. The first is, I guess, the expectations for March. Do we get any signalling around that? Our sense is that it's likely that he will lean on data dependence. He's going to keep that on the table, keep that optionality open. And then the second is around, I guess, some of the potential for kind of how they react to the incoming administration and the policies that we've heard kind of announced so far and how that's feeding into the thinking in terms of rates as we go through this year. How
balanced is the dual mandate right now? How balanced is the growth versus inflation debate? How balanced is the debate about whether or not the next move is a cut or a hike? It seems that we're kind of at the pivot point at the moment.
I think that's a really good point to raise, because obviously at the December meeting we saw this kind of shift towards kind of concerns over inflation. We saw the summary of economic projections. We saw inflation expectations from the median participant revising up for this year. We heard concerns over the kind of incoming inflation data. And I think as we go into the beginning of the year, this is the point where we tend to see kind of slightly higher inflation numbers anyway. So I do think there's a focus on the inflation dynamics currently. But one of the things that we've been noting is that, the narrative can shift relatively quickly between the kind of inflation concerns and the labour market's concerns. And even though we had that strong December print, we think there's some temporary factors that kind of help to support that data. So our sense is still that the kind of underlying trend in the labour market is one of slowing. And so I do think there will come a point where you see that kind of pivot in the narrative back towards concerns over the labour market. But I think it's going to take some time, because I think the next couple of months of inflation data will be absolutely critical, really, for the inflation dynamic for the year.
OK, so that's, Abigail, why we look to guidance on March then, I suppose, and whether there's still the possibility of a cut because of what you're saying about the employment market. But on the inflation side, there are a lot of people concerned about Trump's policies. And I wonder how the Fed starts to handle this. I mean, on the one hand, you can see a world where the Fed says, look, we just have to deal with the data that we've seen, and we can't, and policies that are just being talked about, we can't factor into our models. But policies that are really obviously going to come our way, or executive orders that have already been issued, how does the Fed get around factoring in those? And some of those might look inflationary. Immigration, for example, tariffs.
Yeah, so I think we heard a little bit from Chair Powell at the press conference in December around this. And, he was asked around how much the kind of incoming administration had factored into some of the changes we saw in the summary of economic projections. And he said that, some people had baked that into their estimations and some people hadn't. So I think there's always going to be different ways in which members of the committee are bringing that into their thinking. But I think ultimately the message we've had from Chair Powell is one of potentially not being too preemptive, and instead potentially having to be more reactive in policy making. And that's largely because if we think about tariffs, for example, there's been already a number of different proposals since Trump entered the White House. And I think one of the lessons that we learned from 2018, 2019 is that even though, tariffs might be proposed, they ultimately might not end up being enacted. And I think in terms of monetary policy making and monetary policy setting, it's what's actually enacted and what's actually going to feed into the data that will matter for them.
I mean, where you say that the Fed's emphasising data dependence, and they may emphasise data dependence in the press conference, do you actually think that there's a risk they lose credibility if the decision appears to be more driven by the external pressures, this wait and see for what Trump does? I mean, when you're looking at the data, what is it particularly that's just justifying a hold today?
Yeah, so I think obviously as we went into the end of the year, we saw some stickiness in the inflation numbers. You know, I think that's the key thing about the changes in December. It's hard to discern how much of the change in concern over inflation was driven by the recent inflation dynamics versus potentially members factoring in some of the influence and the policies from the White House. So I think it's hard to discern those two things, but I do think the key thing around data dependence is going to be whether you see some of the upside surprise that we saw in the January inflation data last year. Do you see a similar surprise this year? I think that's actually going to be one of the kind of key critical data points as we look ahead for the Fed.
Guy was kind of joking earlier about the way Trump's going to be tweeting alongside...
Posting.
Sorry, we are in 2025. Yeah. Alongside this press conference from Powell. And, you know, of course, he's been so critical of Powell and, you know, all these threats about appointing a shadow chair. Do you actually think that will undermine the Fed's inflation-fighting credibility? Not maybe swaying policy, but do you think it undermines the Fed in the eyes of the public and the inflation expectations?
So I think, obviously, Chair Powell is always incredibly careful when talking about politics, when talking about the influence that potentially some of the actions of the administration might have on monetary policy making. And I think the way that he looks at it is they will react to the way that the policy influences the data. And I do think that leaning on the data dependence allows them to give that signal. We're reacting to the changes in the data and our expectations around how the data is going to evolve. And I think, you know, forecasters have to be humble. They may not be right. They may get it wrong. And a lot can change. And one of those dynamics is the policies that will influence the data, right? So I think by focusing on that, you know, I think that's one way in which they kind of separate themselves from the politics. They're reacting to the way that the policy influences the data. Yeah. I think that's how they'll message that.
And it all takes a long time to come through in the data. So you'll see where that takes us. What about on the fiscal side then? Just to finish off, Abigail, Trump has appointed Bessent, of course, and we've heard a little bit about his thinking on what he wants to do with treasuries and the like. What are you taking away so far from what we expect on the fiscal side?
Yeah, so I think our overall expectations on the fiscal side, I think ultimately if we look at the budget in the US, there isn't a whole lot of room for a huge amount of fiscal stimulus, but there is a lot of fiscal kind of deadlines coming up for the US, right? We have the kind of debt ceiling issue. We have the need to pass the appropriation bills for the fiscal year 25 budget. And then we also have the expiration of the 2017 tax cuts at the end of this year. So there is a lot for Congress and for Bessent to kind of be looking at in the coming weeks to try and address some of these kind of fiscal issues. But our overall sense is that we don't necessarily see fiscal policy as being significantly stimulatory in the coming years.
OK, interesting. Abigail, thank you very much. Thank you for joining us. Abigail Watt, US economist at UBS, of course. A reminder to catch Trumponomics, a new weekly podcast focused on the Trump administration's economic policies and plans. That's with host Stephanie Flanders here at Bloomberg. New episodes every Wednesday on that one. Coming up on this programme, we'll return to the EPAM Private Equity Conference in Cannes, where Kriti will be joined by KKR's Aliza Wood. Stay with us for that conversation. This is Bloomberg. Welcome back. This is the opening trade. 30 minutes until we get that European opening trade. Let's have a look at the futures picture. And it's pretty mixed, actually. We've got the CAC 40 futures picture a little bit weaker. Euro Stoxx 50 futures, though, broadly speaking, positive. There's some ASML effect, no doubt, in here. So we'll look to the Dutch market to see what kind of positivity we price in, having seen that blowout number when it comes to the orders figures at the chip machine manufacturer. A quick check on the bond markets. We are heading towards a Fed meeting, of course, and so no doubt that sets the direction overall for global sentiment around bond markets. And, of course, we come out of that tech trouble at the beginning of this week. Both of those have been influencing demand for fixed income.
Tech trouble. Love it. ECB tomorrow as well. We should probably factor that into our thinking too. The EU's Financial Services Commissioner says cross-border banking consolidation will benefit European consumers. National governments in Europe have been pushing back, of course, against recent merger efforts from the likes of UniCredit, which has approached Commerzbank. Maria Luis Albuquerque has been speaking exclusively to Bloomberg's Ollie Krug.
The banking unit, it is a natural consequence of banking union to see cross-border mergers. We have the decisions are, according to the banking union rules, decisions are made for prudential reasons by the ECB, also assessed for competition reasons by DG Competition, and those are the rules. If they agree that the merger can go on, then all which is necessary under the banking union is complied with. The issue is that we need to understand that bigger banks can provide better services at a lower cost. And we do understand that issue of scale. If people go to big supermarkets, why? Because they have wider offers at lower prices. It's the same with banking. If we have bigger banks operating cross-border, it will be to the benefit of all clients. They will have more services being offered at lower cost. That is the drive for banking union. The banking union does allow or promote that kind of movement.
I'd also like to get your perspective on something that's also happening quite some distance from Europe, which is in the United States with the Trump administration, which has taken a very sort of slash and burn approach, shall we say, to regulation, particularly in financial services. One of the great critiques within Europe is that it is over-regulated. Even the Draghi report highlighted that something like 10% of GDP is lost due to over-regulation. Is that something you're going to have to look at in financial services in order to, particularly in an environment where the Trump administration is rolling back a lot of regulation? Does Europe need to deregulate on financial services?
I do not use deregulation, and I do not like the expression deregulation, because to me that brings back concerns about financial stability, and financial stability is a precondition for success. No matter what you want to do, you need to maintain financial stability. But there is clearly a need to have better regulation, simpler regulation, to reduce the burden that it imposes on companies. Actually, all commissioners have that on their mission letters, so we should all focus on how to reduce the burden of regulation and make it more fit for purpose. So we need to simplify, not to deregulate.
EU's Financial Services Commissioner speaking exclusively to Bloomberg's Oliver Crook. The Trump effect starting to have an effect in Europe, it certainly seems. Deregulation, we'll talk about it here in the UK, maybe a little bit later on as well. Deregulation, a bonfire of some of the regulations, particularly around the green agenda, I think could be part of the agenda going forward. We are maybe going to see a little bit more of that as well, coming through in the form of the compass.
Yeah.
This compass idea that Europe is taking away from the Draghi report, a direction of travel, maybe for Europe.
Yes.
When it comes to growth.
Yes, and Draghi's report came out before Trump, but you're right, Trump adds extra impetus perhaps to these initiatives, but they were to some degree well understood before even the second term of President Trump.
Understood, but not acted
on. But not acted on, no. And I don't think a competitiveness compass counts as action necessarily either, does it? But we are going to get one. This is from the Europeans, so this is on the European side. How to compete with the US and China over the next 5 years, but it doesn't necessarily come with any money, and that's the big issue.
And the point,
and that's where Capital Markets Union comes in and using those savings in Europe.
And what about the cost to consumers of deregulation? Politicians can talk about it now, but the accountability for that will come down the pipeline. So you can enjoy the growth if it comes, you're going to pay the price later.
There is an argument, though, that does say, do you actually need more money? Or do you just need less friction in the system? If you take friction out of the system, can you do more with less? And it's probably a little bit of both. Maybe you do need to spend some more money, but maybe you also need to take some friction out of the machine too. And if you can do that, maybe you get a more freewheeling economy, one that's more adaptable, innovative in Europe, because that's not what it feels like at the moment. It feels like Europe is heavily constrained, European business, the European economy, heavily constrained by some of the kind of the regulatory wrapper around it.
And that's what we heard from the Commissioner around the Capital Markets Union, saying that this is now so urgent that they're going to think about doing this with fewer than the 27 members of the EU, just taking a kind of coalition of the willing and asking them to demonstrate the benefits of Capital Markets Union and what can be delivered.
Even
then.
the French are talking about deregulation.
Yes. Yeah.
Which is saying something. Well, let's go to France now. After 2 years of falling deal values, 2024 saw the capital markets warming up. A second Trump presidency, though, and changing government policy in Europe could temper or turbocharge the recovery. So how confident are private equity firms feeling? We can go back to Kriti Gupta at the EPEB Private Equity Conference. She's in Cannes. Kriti, who are you speaking to?
Lizzie, thank you. I'm here with Elisa Wood, a partner at KKR, joining me in this beautiful location. It's really important. You guys were just talking there about this idea of deregulation, this idea of kind of a complete 180 coming out of the United States. But I think another theme we've been talking about this week, in addition to the deregulation, has been the cost of capital, specifically in the AI space. We know earlier this week it really threw the markets for a turn when DeepSeek out of China really changed the game in terms of how much input costs require to get that to that next leg of innovation. But a lot of the folks here have been talking about the fact that this is a trend that's been in place for a very long time. The cost of capital is coming down in a big way. To what extent do private markets bringing in that cost of capital down kind of help speed up the process?
Sure. In the AI space, this democratization of AI, we actually believe is like a deflationary event for the end consumer, right? I think speeding up that productivity, speeding up that innovation is probably a good thing for everyone around. Now, how does that translate to returns, right? And there are lots of, I would say, pressure points on returns at the end of the day, especially in the private markets. It's everything from, higher inflation, higher rates at the end of the day. I think if you're an investor today, what you need to be looking for is how do you generate that end return, right? Are you relying on that cheaper cost of capital? If you are, well, then you probably have a problem in generating that long-term return. If you're focused on the growth of the business that you're investing in, really that bottom line driver, then you'll do just fine, right? And I think that's why when you think about private markets and private equity in general, it really is more of the who versus the what. You need folks that are cycle tested, have that all-weather approach, who understand how to drive that operational alpha. And if you know how to do that, you can really lean in this moment and drive, honestly, I think, some best-in-class returns.
So the best-in-class returns is where I want to pick up here, because we've seen some enormous ones in the last 5 years alone. A lot of that coming from kind of the search for yield, and it's created this massive fund flow in the private markets when the stock market, the bond market, maybe even the commodity market is looking way too expensive to get near. So why not throw your money in maybe something that has a little bit more longevity, the private markets? But that was a very macro thematic driven kind of fund flow, one that hasn't yielded results, say, in the IPO markets, for example. Do the next 5 years look like the last 5 years?
I think it's the question we're getting from every investor that we see around the world, whether it was Davos last week or here in Cannes this week. It's one of those things that, at least from our perspective, the last 5 years is not going to look like the next 5 years, right? So when you think about the correlation between asset classes, when you think about return drivers, when you think about, at the end of the day, just the compression of overall returns in the public markets, right? I think we would all agree the next 5 years probably isn't going to look public return-wise the way it did before. So what do you need to do? You need to close that return gap. And I personally think we're entering what will be the golden age, if you want to rewrite the history 5 to 10 years from now, what will be the golden age of private markets, because I really do believe private markets will be that return gap closer. Because at the end of the day, if you can lean in, this goes back to the how do you generate the returns. If you can work the companies, if you can increase growth, if you can increase innovation. We went from a world of, I would say benign globalization to great power competition. So investing in those local national champions and helping them be best in class, by the way, that's good for returns, but that's also good for the end consumer. So I think this is that moment in time where to really close that return gap, we're going to need to use private markets unlike anything we've ever done before. Now, I think the problem is when you look at private markets, all private markets aren't the same. All managers aren't the same, right? It's finding that needle in the haystack that really can drive that return.
It's fascinating that you talk about this and this idea of kind of local and national champions as well. I'm going to kind of bring it full circle back to maybe where we started here, and specifically what our folks and my colleagues in the studio were talking about, which is this concept of deregulation, that so much of the spillover effect is coming out of the States. But so much of the spending and the infrastructure investment is coming from right here in Europe with the European governments in places like AI, in places like defense, for example. And we know this is a place where KKR also operates and trying to get a lot of that funding through. Walk us through that longevity piece of it. Is the success for some of these really juicy parts of the market right now, infrastructure, family offices, et cetera, is it dependent on stability out of France, Germany, et cetera? To what extent are those returns dependent on what comes out of the government?
See, I might even take the other side of that, because I actually think the more volatile or the more complex the geopolitical environment is, you could actually get some more interesting things done, right? So if you could be that port in the storm where you can use very basic operational practices to help navigate some of those political challenges, that's what winning looks like. That's what good looks like. If you're trying to place bets on the political whims of the day, you've got a 50-50 chance, right? It's like, are you betting on black? Are you betting on red? Like, at the end of the day, where is it going to go? That's not the winning strategy, right? Like, we like to always say, you've got to control what you've got to control. You got to make your own luck. So, yes, does the political climate matter? Of course it does. But I think that uncertainty and that complexity probably leads you to be the partner of choice in these moments, right? Whether it's partnering with families, whether it's buying non-core assets out of large corporates, whether it's taking companies private. Like, these are all the arrows in our quiver of how to win on the deal side. And I think that really comes through today.
You use that key phrase, port in the storm. That has been one of the almost Achilles heels of getting investors to really put their money into private equity prior to maybe the last 5 years. The idea that it's not liquid enough, you aren't seeing enough turnaround. We've certainly seen some of those concerns in the IPO market starting to pick up a little bit. Is private markets going to get perhaps that more liquidity, that more kind of vehicle for turnover, the more that people get involved? What does that timeline look like for you?
Well, I also think there's this shift in wealth around the world too, right? So I think institutional investors have understood exactly what you just said, that you will get paid for that illiquidity premium. If you're investing with the right manager, you should be getting paid for that illiquidity premium. But I think individual investors around the world have not had some of those options that institutional investors have had, right? So if you look at the $190 trillion of wealth around the world that sits in individual hands, less than 1.5% of that has actually been in the private markets. I actually think that's the opportunity, right? It's helping investors around the world, regardless of your size, understand that if you want to generate 700 basis points above the public markets, you're not going to do that by sitting on your hands. You're going to do that by understanding what long-term capital appreciation means and really leaning in with the folks who know how to do that the right way. Because I think the biggest issue in private markets is, how do you find the who? Right. There are thousands and thousands of managers at the end of the day. You know, I think in the U.S. alone, there are more private equity funds and private market funds than there are McDonald's. Right. So how do you find the one? And by the way, does it matter? And the answer is yes, it does. Right. The dispersion of return in those managers is somewhere between first and bottom quartile. It could be 1,500 to 2,000 basis points. In the public markets, by the way, that dispersion is 200 to 300 basis points. It matters a lot less on the who in the public markets than it does on the private side. So I think it's understanding the liquidity, but also understanding the ways that you can drive that long-term capital appreciation.
Elisa, always a pleasure. I'm so glad I got to spend this beach time with you right here in Cannes in the freezing weather. We thank you so much. Elisa Wood, a partner over at KKR. Lizzie, she's talking there about really that massive wealth transfer you're seeing around the world, how maybe private markets this time around are quite insulated perhaps from the whims of what you're seeing in terms of policy on both sides of the Atlantic. The next step is, how do you get that money in the hands of maybe institutional and private investors, and maybe even everyday investors who are saying, well, those returns look good. How do I get in on that?
All right, great conversation. Kriti Gupta over at EPEM in Cannes. A very beautiful port, not too stormy yet. Coming up on the programme, ASML shares indicating higher this morning after the Dutch company reported orders for its chip-making machines that smashed estimates. We'll bring you all those details next and take a closer look at the other stocks to watch at the open. Stay with us. This is Bloomberg.
Twelve minutes to the opening trade. ASML calls sharply higher on Tradegate. This after the company said orders in the fourth quarter were more than double what analysts had expected. This as the AI boom continues, at least for now, to drive demand for its chip-making machines. Let's get more details on what we should be watching here. Tom McKenzie joining us around the table. Tom, is this as good as it gets?
I think it's a very valid question. Most analysts are looking at these numbers and they are very positive on what they're seeing, because, of course, the numbers for the fourth quarter blew out the estimates.
Yep.
So 7 billion euros in terms of the bookings for the fourth quarter, more than double the estimates of 3.5 billion, or around about that point. They're seeing still demand. They're meeting that demand out of China. 27% of sales still coming through from the China market. That's the less sophisticated kit that, of course, is not subject to those export controls. And the CEO, Christophe Fouquet, saying that AI is the clear driver of demand. He says AI is creating the shift in the market. To your point, with all these question marks about the capex spend as a result of DeepSeek and what we've seen evolve over the last few days, does that demand for this very high-spec kit that costs about $380 million per machine. Is that demand going to continue beyond 2025? 2025, it seems like they have the runway to go through. They have a backlog of 36 billion euros in terms of order demands, backlog of bookings that they have to fulfill. Most analyst notes responding to this suggest that 2025 is looking like a glide path at this point for ASML. 2026 is the question mark.
What about where ASML sits in terms of the geopolitical crosshairs? Is this as good as it gets when it comes to export restrictions or lack of?
Export restrictions, and we heard from the Dutch Prime Minister, fully expects export restrictions to remain in place, if not get tighter under the Trump administration. ASML have said in this earnings story, the CEO has said these have been factored in to the guidance for 2025, the export restrictions. There's a big question about tariffs because, of course, ASML is, on one level, a supply chain story. Hundreds of thousands of components, very sophisticated, go into these machines. CEOs of the past have said that ultimately running ASML is like running the most sophisticated supply chain on the planet. So will they be immune from tariffs? No. Have they become adept at mitigating those? Do they have systems in place? Yes, clearly this is an environment they've had to adjust to. Additional tariffs, wherever they land globally, are going to be a factor for ASML, and they'll have to weigh those up.
Tom, thank you very much. Bloomberg's Tom McKenzie with the latest on ASML. This is a story that looks set to put fire under the European stocks opening trade this morning. Certainly the AEX would be expected to be higher on the back of this. So we'll certainly watch that. And thinking more broadly about where the Open goes, let's talk to our Markets Live executive editor, Mark Cudmore, who's with us as usual this morning. And Mark, so ASML clearly a big focus for us here in Europe, but the wider tech sentiment story is really interesting. Very negative for big US tech, or specifically NVIDIA and those connected with the electrification of the US economy at the start of this week. That was all quite negative. Then we saw something of a rebound in yesterday's session, didn't we? And it seems we're not at the end of working out exactly what DeepSeek does to productivity and to US tech.
Yes, Anna, I think that there's two big things to distinguish. A is the time span between the immediate short term and the longer term dynamic here. Longer term, the dynamics of the past week are really, really immensely bullish for global growth, global productivity. It's about the productivity boom and for global stocks as a result. Now, short term, that doesn't matter as much. Short term, it's all about those earnings. And as you've seen with ASML this morning, that was kind of very, very strong. The other bit that needs to be distinguished is what it means for tech versus the rest of the world and what it means for US tech versus the rest of the world tech. So first of all, this global productivity boom is going to be mainly good for non-tech companies. But it doesn't mean that AI suffers. AI is all driving this. It just means the premium around AI is maybe it's less kind of unique or less specialized because suddenly through an open source cheap model, the whole world can benefit from this and it becomes much more about tailoring, software, etc. Much more chance for other people to innovate. So I think the benefits are more widely spread and therefore the premium shouldn't be so focused on US tech. And that also matters for US tech versus rest of the world tech because rest of the world tech, particularly in China, Hong Kong, was perceived to have limited access to this kind of AI boom. That is now being broken and therefore they're going to really, really benefit from that in the coming months, whereas US tech, absolutely solid companies will continue to make massive amounts of money, will continue to be world leaders, but their valuation premium is no longer justified distortion to the rest of the world. So this is globally very bullish, but it's much less bullish for US mega cap tech than it is for much of the rest of the world.
Mark, can we transition from a world where US tech, mega cap tech, has driven particularly US indices higher to a world where we see a broadening out, not only in the US, and to the rest of the world? Can that happen smoothly, or is there an air pocket between one and the other?
It's a great question. There definitely could be an air pocket. You know what? There's lots of reasons, short-term issues that can decide that, and sometimes, the broadening out is a multi-year theme. There's a massive. We've 15 years the other way that we've got to kind of unwind in terms in a bullish way, broadening out. There could be air pockets for all sorts of reasons. There could be for micro reasons, just because earnings are terrible. That doesn't seem like the sign this week. Or it could be something that happens on tariffs or interest rates. So you can't guarantee that there'll be no disruption, but it's not necessarily that there has to be disruption. That means that's why we've got to monitor markets every day. But the long-term story is very positive and bullish for global stocks.
All right, Bloomberg Markets Live Executive Editor Mark Cudmore, we thank you. And let's go now to our stocks to watch with Joe Easton from our equities team.
Morning, Lizzie. So LVMH's ADR slumped as soon as the numbers hit last night, though it did recover very slightly, was down around 2% at the close of the US ADR session. And the reason that it was weak is that expectations have risen into this report. Analysts at JP Morgan writing in a note that although there was a sequential improvement in LVMH's sales, it's not as big as was expected following the updates from peers like Richemont and Burberry. Then we are going to also be looking at a bit of a read across in some of those shares and also looking at the drink stocks today as Remy gives another really disappointing update, predicting sales could decline as much as 18% in the year ahead. We can see that stock down almost 70% on a 3-year basis. Then going over to the auto space, not much to cheer about over there either. We got Continental, firstly in the auto parts business, saying that their automotive unit continues to struggle. Also keep an eye on Volvo, a bit of weakness in the truck space this morning.
Thank you very much, Joe. Joe Easton from our equities team. So lots of individual stock names. Reporting season is upon us. We will bring you the opening trade for all of those and the broader sentiment around the markets. We will watch ASML, of course. This is Bloomberg.
Wednesday the 29th. Good morning, folks. Big day coming up. You've got the Fed to focus on. You've got the earnings picture to drill into. And, of course, then the football comes a little bit later in the form of the Champions League. Massive day coming up. Let's talk about how that's all going to impact the European Open. Let's start with yesterday and think about what the session looked like. US markets continue to rally after the European markets had closed. In fact, we faded into the European close. So, in theory, we're going to see a pop at the Open. I suspect it's also going to be a battle in Europe this morning between ASML and LVMH. How that balance works out, I think, could be really important for how the session progresses. Lizzie, what are you seeing in the futures?
So we're catching that positive sentiment from Wall Street yesterday, Guy, and it is boosting Euro Stoxx 50 futures higher 0.8% as we get towards the Open. Also boosted, as you say, by those ASML earnings, beats across the board, and hence why Euro Stoxx 50 futures are higher than the CAC 40. You've also got to take in the LVMH story, disappointment there, so disappointment expected in Paris. What are you watching in terms of individual stocks, Anna?
Yeah, let's go through some of those. And in fact, we'll go to sectors because chips really are in focus. ASML and any read across into other chip-related businesses will certainly be something we watch. We are expecting ASML to go substantially higher at the start of trade. Luxury stocks in focus, as you both were saying, LVMH is the driver there, telling us a more negative story perhaps on the United States than Richemont. And so how will that be received by the markets? The market rallied quite a lot. The sector rallied on the back of those Richemont numbers on the 16th of the month. And then we've got a couple of themes in the auto parts and wider auto space. Continental, for example, in focus with some talk of incremental auto margin improvement next year, and Volvo Trucks, a negative sentiment there around truck demand in Europe, Guy.
OK, here we go. Time for the opening trade. Remember, ASML closed Friday at circa 700. We're going into today's session around 650. We've still got to fill the gap. So let's see how the FTSE's opening, but let's critically see how the AEX is going to open this morning. How fast will we get that stock open? How fast will we get that market open? Let's wait and watch. But certainly the early indications are a fairly flat opening coming through out of London. The stock 600 is up by 0.1%. The IBEX is up by 0.5%. So some better news maybe coming through from Madrid. But we wait for the AEX this morning, and we really wait for the CAC as well. Both of those two markets absolutely critical, as they contain, of course, ASML and LVMH. How are those two stocks going to trade today? Very important for this European session.
Yeah, let's talk you through some of what we're seeing on the sector side of things then. Consumer products and services is by far the biggest downside drag here. And we have LVMH falling quite substantially. Kering also down on the back of that. Christian Dior down on the back of these numbers out of LVMH. So real negativity for the luxury sector. As I say, it rallied quite a lot on the back of those Richemont numbers. That was compounded, that positive sentiment about the US, by the Burberry numbers as well. All of that led the sector higher. And today we've heard something a little more lackluster. Doesn't matter how much Arnault thinks there's a mind of optimism in the United States. Right now, the markets are selling luxury stocks. In terms of, so that's the downside, but we are waiting, I think, still to get an opening price on ASML, and that might provide us with the upside.
Stock's halted at the moment, by the looks of things.
If I bring you some of the other earnings stories that we've got in terms of stocks that are moving at the open, you've got WH Smith up 5.7%, Rummy Quantro down 2%. As Joe was telling us, they had that sales sales decline in the US, consumers cutting back on their drink spending there. Volvo trucks up 3.2%. We also had as Axo Nobel, and that's down, I should say, 4.2%. So as we wait for the CAC and the DAX to open, those are some of the individual movers.
So let's just think about the range that ASML has traded in over the last few days. The high over the last few days, 752, we came through at the end of play Friday at kind of just a little bit further north than 700. So we were fading into the close on Friday, but still we had a 7 handle attached to that stock. The stock then gaps lower Monday morning as we see the DeepSeek story come through and bite. We rally a little bit. Yesterday we just go sideways. We're expecting the stock to rally this morning. We're waiting for the opening trade, but it's still got a gap to fill just to get back to where it was on Friday, and it's got a big gap still. So in some ways, yes, we're seeing positive numbers this morning, but we're kind of progress have we really made?
Well, because these numbers, they don't tell you a huge amount about the thing that the markets are worried about, which is DeepSeek and its impact on demand for expensive machines. It tells you that they've delivered really incredible performance over the last quarter, and the orders for the first quarter, they're upgrading those. So that all sounds so far so good. But if people have longer-term concerns about the sustainability of demand, that's something we can't answer based on these numbers.
Do you look at the ASML numbers today and say, I have to wait for Microsoft, I have to wait for Meta? Now, Meta's already pre-announced because it got burnt last time in terms of what it's going to be delivering on CapEx. So we already kind of know those numbers. What are the other big hyperscalers going to be doing? And does that model change going forward? Is the guidance in terms of CapEx, does that change? So do you wait on ASML and wait and watch and see how those numbers progress before you make a decision on whether or not this stock kind of rallies significantly from here?
Of course, TSMC already upgraded its guidance on CapEx spend. So this is to Tom's point. You've got the 2025 period cushioned. It's the period beyond that.
But the ultimate customer is the hyperscaler. And do you take your lead from there in terms of what you're going to be doing next?
Yes, let's get into all of this with somebody who knows about buying tech equities. Now, let's have a conversation about tech stocks. And as a walk-up to that, let's think about what we heard from Cathie Wood yesterday. ARK Invest's Cathie Wood joined us around this table to reflect on Monday's punishing tech sell-off. Let's remind ourselves of what she had to say.
I think what it's telling us is the cost of innovation is collapsing, which it has been doing. I mean, the cost of AI training is dropping before this, 75% per year. The cost for inference, 85 to 90%. I think it throws the weight more towards inference chips from training chips, and so NVIDIA's highly exalted, and deservedly so, in the training chip space. Inference is a lot more competitive.
That was our conversation with Cathie Wood, reflecting on an incredible week in tech already, and we're barely even halfway through it, not even halfway through it. Let's just tell you that ASML has now opened. The price of those shares up by 10.5% this morning. So the market is reflecting a little more positivity, a lot more positivity around the numbers that we've heard about this morning. We'll come back to the ASML story, no doubt, shortly. But let's go to Alison Porter, Portfolio Manager on the Global Technology Leaders team at Janus Henderson, who joins us this morning with her thoughts on the sector. Alison, nice to have you with us. We were just hearing from Cathie Wood there, and she was talking about how, in her view, we've learnt this week, because of what DeepSeek has told us, that the cost of innovation is collapsing. Now, then there are some who raise a sceptical eye about regulation in the United States, about how exactly DeepSeek did this for such low cost, whether they were piggybacking on other AI models, and maybe that matters and maybe that doesn't matter in terms of where the sector goes next. Alison, what are you taking away from the DeepSeek story and what it does to the maths behind these expensive chips?
Yeah, I think the last week has seen, AI capex announcements from Stargate for over 500 billion, and then through to the DeepSeek story that really cast a concern initially on the lower training cost. Was that going to really damage the capex story? And then I think people have now started to focus on the fact that this cheaper inferencing does make more innovation and can drive more demand. I think, they talk about Jevons paradox, which is, as efficiency ramps and costs comes down, you see demand and you see a broader range of applications for AI. But I think time is a key dimension here. It will take time for these cost reductions to flow through, for all applications to be able to embody what DeepSeek has managed to do in terms of open source. And it'll take time for the demand for all of these other applications to really ramp. And we'll hear a bit more about that when we hear from Meta's earnings and Microsoft's earnings this week.
Just a little more, Alison, on the time horizon that you would expect to understand fully what it is that DeepSeek really brings. Because on Monday, we heard from a guest who was saying, look, it might take months for these big tech companies in the United States to work out how DeepSeek is doing what it's doing and therefore what it means for their businesses. But you sound as if we might get some answers this week.
We'll get some insights. I'm sure, remember that DeepSeek was also built on the back of Llama 3, Meta's open source large language model. So these companies are iterating constantly. I'm sure we'll hear from Microsoft on further developments as well. So I think, what the key focus this week is going to be on fundamentals, what kind of returns that these companies are already seeing on their AI investments. And really what, DeepSeek represents is this opportunity and this balance between CapEx expenditure and also the OpEx implications longer term, which we've not heard a lot about, that actually we'll be able to innovate and OpEx may continue to trend lower.
Alison, good morning. It's Lizzie here in London. I think I'm right in saying more of your portfolio is Microsoft than Meta. When you talk about the open source element, do you agree that Meta's in a better position to deal with the DeepSeek threat because its AI model's open sourced? Does this put you off Microsoft at all?
No, and I think, look back to artificial intelligence as a wave. And, when you look back even to the internet wave, we did have a surge in open source and Linux, but that didn't stop Microsoft and closed source models also doing very well. So we think there will be more than one route. And open source is certainly driving a lot of the pace of innovation just now. But we expect OpenAI and Microsoft and others there to be more than one method of innovation throughout this wave.
And you also hold Apple. We're waiting for their earnings too. Where's Apple in this AI evolution? How much could the DeepSeek developments actually help Apple?
Well, I think, Apple has been the winner in the mega caps over this last week, despite the fact that there's incremental concerns on share loss in China. And we will see some form factor change in Apple, which usually drives some upgrades. But really, DeepSeek, dramatically decreases some of the memory requirements for inference. And that makes, using AI on the edge more viable. And that really fits into, Apple's position in the ecosystem. It's very well positioned for all of the data that we share and being able to use AI at the edge.
Alison, how close are we, or are we at peak capex?
I think, the step up that we've already seen this year from last year is less for many of these companies than it was in 2024 versus 2023. So, there's the peak in the absolute number and then there's the peak in growth in CapEx. And I think, we are with the announcement of Stargate, with Reliance, we're seeing CapEx announcements around the world from many sovereign funds. So we may see peak capex announcements this year, but the expenditure will continue to grow over the next few years because we're really building out for artificial general intelligence, not just this generative AI wave.
And what's the ROI on this? Is that where the question should really be asked in terms of the ability of every dollar spent to deliver a return? Do we need to question that more now post DeepSeek than we did before?
I think, the commoditization of large language models, does create a focus on what the monetization of AI will be, just as we've seen in past waves in the mobile internet and on the internet itself. I think we will see, advertising tends to be a place that we start to see that return come best. But as I mentioned earlier, I think a key portion is seeing what OpEx savings companies get, because ROI is not just about the incremental revenue generation, which may take more time, but it's also about the cost that can be be saved over the next 3 to 4 years.
A headline crosses. Alibaba touts new AI model superior to DeepSeek's and Meta's. The competition is certainly heating up. Alison Porter, thank you very much indeed, Portfolio Manager at Janus Henderson. Let's take a look at what the Core 6 looks like this morning. There's one name that certainly does stand out, and that comes in the form of ASML. However, I would just caveat this. Go to your Bloomberg terminal, look at the 5-day chart. We filled the gap. We're still a little softer, though, where we were versus kind of, I think it's probably 11 a.m. on Friday. So this stock is rallying and roaring today, but in reality, actually, maybe for a longer-term investor, very little movement in the stock over a more medium, maybe even a short-term picture. Joe Easton's here with more. Let's figure out what's going on out there, Joe.
So ASML really the standout, as you say, Guy. That stock actually having its best intraday gain in 4 years now. So that stock was up around 12% at the open. We're now up around 10%. And seeing that feed through, ASMI up 7%, and the other rivals, BE Semi, Soitec also gaining a lot of green coming in, given the orders smashing expectations for ASML. Then, in terms of luxury, it's kind of the exact opposite in terms of expectations did come up ahead of these results, given we saw beats for Burberry and the likes of Richemont. But we are seeing LVMH now coming down almost 5%, and the peers also sliding as well. Expectations coming back down as China continues to slow for LVMH. And also drinks. It's another China story with Remy Cointreau giving very downbeat guidance once again, warning sales could drop 18% in the year ahead. That is the low end of the range that they previously gained. But a lot of those drink stocks have been absolutely slammed over the past couple of years. Potentially some of that priced in, but 3% declines for Remy, and also Diageo slipping on the screen as well there. Then in terms of Volvo, a lot of negativity around the orders, but actually the orders here in Europe were better than expected, according to analysts. I was reading the City note a moment ago, and they were saying while Asia continues to be weak for China, Europe looking pretty good. So that is the reason why the stock is up for Volvo, I suspect. Then in terms of M&A, Dowlais. Now remember, this is the company whose roots go back to the old GKN company and Melrose. It was spun out of Melrose, and now there is a takeover offer coming from a US company called Axel, and that is at a decent premium, but we're not coming up as high as we probably should be. That was a 25% premium on that, but it doesn't seem to be coming up to that level. Finally, Pennon in the water space. That one is hit on a rights issue. They've announced to shore up their financing, so the stock slammed on that news this morning here in London. It is diluting the stock. It was at a massive discount for that stock. So one of the worst performers is Pennon here in London this morning.
Joe, thank you. Joe Easton with a rundown of some of those stocks on the move. It really is a fascinating morning then, with some recovery in the tech themes, but selling on the luxury sector. So that weighs on the CAC 40, as he's been telling us. Let's talk about luxury. Coming up on the programme, LVMH's CEO, Bernard Arnault, says a wind of optimism is blowing through the United States after Donald Trump's inauguration. Does that mean better times ahead for the US performance of these luxury names? Shares in the luxury giants are lower today after fourth quarter earnings. We'll focus on the sector. That's next. This is Bloomberg.
Welcome back to the opening trade. We are 18 minutes into today's session. The stock 600 higher 0.4%, boosted by earnings out of ASML. Those shares currently up more than 10%, inching towards 11% this morning. But luxury really weighing on the CAC 40, lower 0.4%, and LVMH down 5% nearly this morning after their earnings. And we can dive into that now with Andrea Felsted. The fashion and leather goods sales at LVMH falling in the fourth quarter, casting doubt on prospects of a quick recovery in luxury demand. Andrea, our Bloomberg opinion columnist covering the luxury sector, joins us now. Andrea, I thought that LVMH was cool right now. These results do not reflect my Insta feed. What's going on?
Well, you're exactly right. Louis Vuitton is still cool, but Dior is cooling. Dior, which has been really, flying for the last few years, is cooling. Loewe is on a tear, but you've got other bits of the group, wines and spirits, the duty-free sales that just aren't doing so well. I mean, I was surprised that it didn't beat more. We had Richemont really smashed expectations. Even Burberry was still negative, but it was nowhere near as negative as everybody expected it to be. Based on that, I thought LVMH would be better. So I was surprised they didn't outperform more.
So the market's got the right reaction this morning?
Oh, definitely. Yeah, definitely. We've had this. It's the biggest exposure to the US of all the luxury companies. The US has really been improving since the election and markets melting up. And until recently, there seems to have been a real upsurge in buying in the US. And Bernard Arnault said he expected the US to boom, but given all those positive factors, it just wasn't quite as sparkling as Richemont, for example.
Do we think that Lizzie needs to upgrade her Instafeed? maybe to get a bit better steer on what's happening.
What about talk about breaking this business up? Is that something we should take at all seriously, Andrea?
I think it is. I mean, we actually, a year ago, did a sort of exercise on what you would get if you broke LVMH up. And if you put the Dior and Vuitton anywhere near the Hermes multiple, which is, over 50 times, obviously it won't be at the Hermes multiple, but you give it a Hermes multiple with the appropriate discount. At the time, that had the same value as the whole of the group. Now, numbers have changed a bit now. Dior's come off. Obviously, the whole industry had a slowdown last year. But this is still an exercise to think about. Bernstein said last week that the wines and spirits division should be spun off. Arnault said yesterday that that wasn't on the card. He was giving the division 2 years to turn itself around. But you've also got the sort of the duty-free business. You've got wines and spirits. So it is the idea that you take LVMH much more to a pure luxury group to get it closer to that Hermes.
Well, yeah, I mean, I suppose that's what it would have to be to justify being comparable to something like Hermes.
Exactly.
Can we linger a bit on what he said about the United States, though? So clearly there's a bit of disappointment in the numbers this morning. They don't stand up to what we heard from Richemont earlier on this month. But he's come back from the US and he's all full of Trumponomics, I suppose, isn't he? And the fact that what he sees is a mind of optimism, certainly, well, probably around the Trump administration, and that's maybe where he spent his time circulating. So what do we know about the read across? This is a really important market for LVMH, the United States.
Oh, totally. It's going to be the market that saves luxury this year. China, he talked about a gradual recovery of China, could take 2 years to get back to normal. The US market is very correlated with stock markets, with Bitcoin. Obviously, that's been on a tear until recently, so that's great for momentum. Since the election, there does seem to be a bit of relief that there wasn't a sort of a muddled outcome, and people seem to have, even those disappointed with the results, seem to have moved on, and they seem to have been spending once more. So the US is going to be really important to luxury this year. The downside is there could be tariffs, so that's obviously one of the reasons he went to the inauguration, to get on Trump's good side.
Friends in high places.
Exactly.
Andrea, on that point, you know these two personalities. How much influence does Arnault have over Trump when it comes to European luxury tariffs, US on European luxury? They go back decades, these two.
Well, Arnault was very, was sort of close to, the Trumps have known each other. He was one of the first chief executives to visit him after his first win. He opened a plant in Texas a few years ago, and reading between the lines, from what he was saying last night, it does seem as if he might do more of that manufacturing in the US for Louis Vuitton, because he was very warm about the fact that you get tax cuts in some states. Opening these plants is subsidised, contrasted it to France, where companies are taxed to make in France. So, we could easily see that's where LVMH is going. Whether he can persuade him not to put tariffs on luxury goods, I'm not sure. Even if Bernard Arnault can do that.
You'd be proud of me, Andrea. I've already done my analysis of Melania and Ivanka Trump's outfits. Bloomberg Opinions, Andrea Felsted, we thank you.
Yeah. I'm going to turn to tech. Much safer ground for me. Let's talk about what is happening with ASML this morning. The shares certainly are on the rise. The chip machine maker soaring after its fourth quarter earnings, smashed estimates. Just take a look at the 5-day chart, though, in terms of the context of where we sit this morning, and put this rally into a little bit of context. You've got to factor in, obviously, what's been happening with DeepSeek over the last few days. Sarah Jacob joins us now from Amsterdam. What do we make of these numbers? They are clearly good, and they clearly give a very solid 2025 picture. But is it possible to determine what happens beyond that? How will the market read what we're getting here? Clearly it's positive, but it doesn't take us anywhere beyond where we were Friday in terms of the share price.
Good morning. Yes, ASML booked, more than twice as many orders as analysts expected. The CEO has said that AI is the clear driver here. He said that the firm believes that AI is creating a shift in the market, and it's seen customers benefiting from it. So if you look at fourth quarter particularly, we've seen that the demand has been driven by ASML's most advanced chip-making equipment, which is the EUV machines. It reaffirmed its forecast for 2025, and it's basically said its view on the long term is still very positive. So that's sort of what's giving the market reassurance today.
OK, so that's the reassurance. But what does this tell us then, Sarah, about future demand for chip-making machinery that ASML makes? Because the concern wasn't what they, going into these numbers, I suppose, was not what they sold in the fourth quarter or even maybe what they'll sell this quarter, but the more medium-term outlook.
Yes, I mean, the elephant in the room is DeepSeek, and ASML stock faced a rout on Monday, as we saw, as did other semiconductor-related stocks, on concern that the new AI model that's come up from the Chinese startup DeepSeek can provide comparable performance to what Western chatbots do, but at a fraction of the cost. So it's basically raised concerns that this could be a disruptor to the current AI business model, which depends on high-end chips and where ASML plays a key part. It's important to note, though, that ASML has not said anything about DeepSeek in its press statement this morning, but investors and analysts will be closely watching for any sort of management commentary at the press conference, which starts at 11 a.m. CET today.
OK, Sarah, thank you very much. Sarah Jacob joining us in Amsterdam with the latest there on the today story on ASML and the longer-term story. So certainly a fascinating one we continue to watch. Coming up on this programme, we will rejoin Kriti. She's still in Cannes at the EPEM Private Equity Conference, of course, where she'll be speaking to the private investment house Ardian. Stay with us for that conversation. Francois Jeffagnon will be speaking to Kriti in front of those yachts. We will bring you that conversation shortly. This is Bloomberg.
9:30 a.m. in Stockholm. The Riksbank has just cut, as anticipated, by 25 basis points, down from 2.5. This was expected to be maybe the bottom of the cycle. So the question now is, where do we go from here? Is the bottom of the cycle maybe 25 bips a little lower than where we are now? The Riksbank rate forecast made in December essentially holds is the line this morning. The Riksbank saying its forecast for policy rate made in December is actually the one that it is going to stick with. So are we going to stick at 225, or do we ultimately go lower from here? Remember, the Riksbank started earlier than pretty much any other major central bank out there and has continued to cut. I think we've done 120, my maths could be wrong here, 125 now. The Riksbank is saying it's prepared to act if outlook changes, i.e. there is the possibility still of a further 25 bips coming off, taking us to 2, which I think will be 150 off where we started.
And you wonder what could change the outlook. And for all of the central banks around the world making decisions, whether you're in the United States or elsewhere, there's the possibility of the Trump effect, what Trumponomics the second time round is going to mean for your economy. Because what it does to the dollar has an impact here. And we've already seen that the Swedish krona has been weakening, of course, against a strong dollar. No surprise there. That's been the longer-term story, as we've seen elsewhere, really whipsawed by the strength of that dollar. And that weakness in the krona has an impact on imported inflation. So that's going to be something, a dynamic that the market is going to keep an eye on.
Yeah, but the Swedish krona barely budging off the back of this, despite that willingness to do more. The question, though, as you say, Guy, really, when does that next cut come? Could it be March? Could it be the second quarter? And really dependent on the uptick in domestic demand, is it maintained? So we have to wait for more data.
We are getting towards the bottom of the cycle, though. We're almost there. The question then is, how long do you stay there? And you just kind of think of the Riksbank as a kind of forward indicator. There's a big debate happening in the States about when does the next hike come. When could the next hike come for the Riksbank? Is that kind of the next thing that we need to logically start thinking about? How long do we stay at the bottom of the cycle, let's call it circa 2%.
There you go. This is euphemistic. The Riksbank sees particular uncertainty about developments abroad. I'm sure that is a copy and paste line that you could take to many central banks globally in this year of 2025. Let us return to the private equity sector now, where, of course, they're also thinking about that unpredictability of policy making from the White House. Cheaper borrowing costs and strong equity markets have given some companies the confidence and capital to pursue deals, with private equity firms reopening their checkbooks to hunt for bargains in the public markets. Let's go back to Cannes and rejoin Kriti Gupta at the EPEM Private Equity Conference. Kriti.
Anna, thank you. I mean, that uncertainty that you were just talking about, that is the exact conversation that we're having right here in Cannes, in the south of France, really talking about not just the interest rate volatility, but the geopolitical volatility as well, and how governments can react, incentivize or decentivize some of the investments as well. I have the perfect guest to talk about it here with me right here in Cannes. Francois, I'm going to say this right, Francois Jeffagnon, and I practiced that for the last 24 hours, the member of the executive committee at Ardian. They oversee about $180 billion of assets under management, and of course have a pretty big stakes we're going to get to in a moment. A pleasure to have you here. Thank you so much for joining me.
Likewise, Kriti.
Of course. Well, we were just talking in the studio about this idea of uncertainty, about geopolitical volatility. We're here in Cannes. Things are sunny, things are bright, they seem okay. But the conversation around France really has been this kind of lack of stability from the French government. Is that decentivizing investment?
Well, you're right. There's more cautiousness, there's more uncertainty around politics, not just in France. I think this is a broader topic around Europe. But, you know, when it comes to private equity, we at Ardian believe that even more than macro or politics, what is important is to focus on companies. So what makes us so enthusiastic? Indeed, the sun is out, and it is also on the ground, because we see many interesting opportunities. We can find, you know, very interesting companies with strong leadership, acting in good sectors like tech, like business services, or even some industrials, where those companies are growing, are being very international. So we see that sense of quality. Quality prevails today and will continue to prevail. And what is important for us is that we want to invest in the future champions of Europe. We're able to do this, so we see the bottles half full, not half empty.
I mean, a very optimistic take when there is so much of that doom and gloom around. A lot of that is perhaps reflected in the capital markets. I mean, there has been this idea that, okay, the capital markets are finally warming up. We're finally getting to kind of getting rid of some of the glut that's been backed up in the system. Is that too much excitement for minimal progress?
You're right, indeed, that it's warming up. When we look at figures, you know, on the M&A market around PE, for instance, you know, 24 was probably a rebound around 15% compared to 23 figures. Still, when we put that into perspective, on the long history, it's still a rather low figures. So, not so great, but I think we need to have a broader view. For instance, in PE, it's not just about M&A, it's also about the secondary market that can provide liquidity. Continuation fund is also another area. And when we see about fundraising, it is more challenging. But you may have seen that we have announced over the 2 recent weeks that we have very successfully fundraised 2 flagship funds. You know, our secondary and expansion businesses, 50% above last vintages. So I think that speaks for itself. There is interest, there is liquidity, there is optimism.
There certainly is. Let's talk about one of those perhaps sectors that are seeing quite a bit of that optimism. This week especially, quite a bit of volatility in the AI space. So we know all, I think we're quite aware of the market turmoil on Mondays after the DeepSeek kind of announcement or maybe wake-up call in terms of the cost of capital needed to invest in AI. But it feels like private markets broadly, I think Ardian included, has been kind of looking at AI for quite some time. What is the next leg of growth in that space? Is it just about getting the technology, or is there a next level to that?
We have been looking at AI for a while, indeed, and several-fold. The first one is obviously how we can invest in that space, and much more than just investing in those who build the large language models. We think it is safer to invest in those around services that provide services around AI. So it's a bit like in the gold rush. You want to invest in those who provide shovels and picks, which I think is safer. So that's one subject. And the announcement of DeepSeek, indeed, this week is comforting us on doing this. The second topic is around how AI can help our portfolio companies to further disrupt their competitors and also enhance their efficiency. That's very interesting, and we are working a lot with our portfolio companies in that space. And probably the last point in terms of growth is how that is going to impact organization. So it's not just about tech, it's much more about adoption and use cases.
Well, does that create then, in this kind of frenzy or gold rush, as you put it, around the AI space, a valuation glut or a valuation premium when it comes to the pricing of some of those assets?
AI brings growth and brings differentiation. So those assets that will be able to ride that wave, which is a long-term one, are going to get a premium. We see the market today being very polarized between the winners and the losers. If you're on the loser side, you will get a discount. If you're on the winner side, you will get a further premium.
Let's talk about another very hot area in PE, and that, of course, is the infrastructure space. We should make a really important note for our global audience that Ardian is the largest stakeholder in Heathrow Airport right now, which is looking to expand. We know Rachel Reeves over in the UK has been very vocal about the plans around the airports as well. Outside of infrastructure, though, if you're a PE investor and you're looking for the gold rush moment outside of AI, outside of infra, where do you go?
So our LPs, they question us about the returns that we have made. They are very happy with it. But much more going forward, are we going to keep delivering these returns and create value? I think this is the word. So how are we doing this? Sustainability is one way. Digital in general, not just AI, is another one. But I think it goes much broader than this. Pricing policy amongst our portfolio companies is a big topic. HR management as well. Talent attraction, talent retention is a big subject. So by us, we have many operating partners, we have strong teams that help us and support portfolio companies, and this is how we create value and today and even more in the future.
All right, so let's bring this full circle right to where we started with around the geopolitical certainty. How much certainty do you need from governments, not just in Europe, but even in the United States as well, to execute some of these deals, especially when, given so much of the kind of excitement around PE, regulation has also stepped up. You saw this in the previous administration in the US. There are talks about it in the UK, certainly in France as well. How are you thinking about the regulatory aspect of this?
We are very respectful of governments as they provide, regulation indeed, which is primarily a framework under which business and PE can operate. This is very important. And then it's our job, and it's also the job of government, to make sure that entrepreneurship, is a strong, not just word, but a reality. And that's what, again, brings us optimism, is that we see still many entrepreneurs that are being able to grow. So this is, I think, the way to operate well, in the current environment.
But then do you pay maybe a little bit of extra attention then to where maybe some of the budgets are going then from a government space? I'll give you an example. In the United States, Donald Trump talking about investing very big in AI. Same thing in China. Giorgia Meloni has been very vocal in Italy in terms of investing in telecom infrastructure, investing in things like defense as well. Do you follow the fiscal budgets to find maybe the longevity you need for the PE markets?
We sure do follow indeed what governments say. This is very important, but even more, this is our job, is to focus more on the quality companies on which we invest and how they can grow further. So it's much more, a bottom-up process. On the ground, this is our job, and this is our primary area of focus, and this is what we're going to keep doing in the future years.
All right, we look forward to hearing how that goes. Francois Chiffignon, the member of the executive committee over at Ardian, and Guy, he's making this really crucial point that even though I think everyone in the PE space is fairly optimistic about the future of private markets, there are still certain things to be keeping in mind. The geopolitics, the government aspects, the pricing, of course. I think I found maybe the lone cautiously optimistic voice in the PE space.
Cautiously optimistic, we'll take that. Kriti, thank you very much indeed. Doesn't Cannes look fantastic down at EPEM? Great day to be there. Let's talk about kind of an extension of that conversation. The UK Chancellor is going to unveil her ambitious plan for an infrastructure boom a little bit later on today. She's going to do so in Oxfordshire. We're going to look ahead to Rachel Reeves' speech and the prospects for expansion of Britain's airports. What else is she going to be doing? We'll talk about all of that next. This is Bloomberg.
I'm not going to speculate on any decision in relation to Heathrow, but I've been absolutely clear what the number one priority of the government is before the election and since the election, and that is growing our economy so that it's thriving, growing it in a way that we get wealth creation in every part of the United Kingdom, and growing in a way that people feel genuinely better off. And I think that's a key test of what we want to achieve in government.
UK Prime Minister Keir Starmer speaking to Bloomberg yesterday right here at our European headquarters, not stealing his Chancellor's sandwiches. She's going to be speaking later today, just over an hour's time. She's going to put flesh on the bones of his growth ambitions. We're expecting her to talk about unblocking new infrastructure projects, possibly giving her backing to the expansion of Britain's airports. And we can talk now to an expert in the field, Dame Diane Coyle, the Bennett Professor of Public Policy at the University of Cambridge. Diane, thanks so much for being with us. I know previously you've been critical of using GDP as a measure of economic progress. We've got growth so much at the front of the political conversation at the moment. Partly you didn't like it because it doesn't account for the environmental impact. When we're talking about Heathrow, for example, if the government wants growth, doesn't it need to forget about net zero?
No, I don't think it's a completely zero-sum game as that trade-off implies. There will be some, and I think Heathrow is a good example of that. But there are plenty of ways to have growth that takes account of the environment, air pollution, and so on. And not everything can be done with the same instrument. So there are lots of other things going on that will help deliver net zero.
But can we really have an AI boom fast without following Donald Trump's lead when it comes to, the drill, baby, drill approach and using fossil fuels to power data centres, for example?
Well, we've already seen that technological innovation in AI is so rapid that it's going to be possible to have models that work without using the energy and water in the same way. And obviously any economic activity is going to use natural resources. So my point about GDP is that it does matter, but it's not the only thing that matters, and you need to be aware of all of the environmental impacts as well. But there will be choices to be made. We've had pretty flat growth for many, many years in this country. People's living standards haven't been going up. We're lagging behind other countries. So I think the emphasis on growth is absolutely right.
Diane, good morning. I'm interested to see the Prime Minister writing in the Times this morning and channeling Margaret Thatcher, saying a change in the economic weather can only ever come from a supply-side expansion of the nation's productive power. In the 80s, the Thatcher government deregulated finance. He talks about globalisation under the last Labour government and says this is our equivalent. Just in terms of our expectation about the supply-side plans that he has, are there shifts we can expect on that scale?
Well, if you do things that affect the supply side, it takes a long time to have an impact, but the impact is large, and the right time to start is now. But I think the idea that this is going to be quick and easy is a little bit dangerous. Things like building infrastructure, once you start, that immediately contributes to economic growth because of the activity. But the longer-term effects will be slow because these projects are large, takes a long time. A lot of things have to get coordinated, the private utilities as well as public investment and so on. And it's equally, the idea that there's some easy bonfire of regulations to happen that will unleash growth is a myth, and it's been tried before. There are plenty of detailed regulations which might be hindering particular parts of economic expansion. But it's not that the whole lot. And in fact, clear, well-enforced regulations actually help economic growth. They create certainty for business. So I think it's the right emphasis. But my job as an economist is to say, actually, it's a bit complicated and inject some doses of reality.
Right. OK, so it is a bit complicated. We don't expect results very quickly. But is leaning into the Oxford and Cambridge arc, is that a move in the right direction? Diane, clearly that will be politically complicated because there's a lot of expectation that growth is perhaps more spread, or wealth is perhaps more spread from his base. But is that going to be something that will deliver more quickly than investment elsewhere?
Well, I think the things that will deliver more quickly are projects like the Oxford-Cambridge arc that have actually been around as an idea for quite a long time. There are other spots in the country where you can see the possibility of unlocking growth relatively quickly. Another one, for example, would be Northern Rail and creating a single job market across those northern English cities and improving the infrastructure there. There'll be several of those around the country. I'm sitting in Cambridge. That's another one where clearly there's more potential for growth in life sciences and AI, but it needs housing, it needs infrastructure. So the government's role in coordinating all of the people who need to come together in these kinds of areas, it's absolutely the right way to go.
Professor, good morning. Where is the UK's comparative advantage right now?
Do you mean in terms of sectors of the economy or areas?
Sectors. Where should we be leaning into? We've talked about Oxford and Cambridge. We've talked about life sciences. AI is another area. Where is our comparative advantage? Where should we be focusing our attention right now that is going to deliver the UK's kind of unique selling points?
Well, I think those are pretty obvious, and this government has named them, and many previous industrial strategies have named them as well. You just did yourself. Life sciences is one. The creative industries is another. 6 to 7% of UK GDP really needs the government leaning into that. Financial services. So there are long-standing comparative advantages. And the trick is getting the coordination across different bits of government policy, across the private sector, that will unlock growth in those areas where we know we have an advantage. And that includes trade talks as well, and an export deal with the EU.
So I'm just trying to understand what the potential is here. We have these comparative advantages. We have some really key sectors that are really important on the global stage right now. We haven't taken advantage of them. There is that potential that exists there. How kind of underperforming are these sectors right now relative to where they could be if we deliver the kind of right infrastructure, the right connections for these sectors to prosper? How kind of underclubbed are they at the moment?
Well, I think quite a lot. If you look at the UK compared to comparator countries, we have underinvested, including in some of these leading sectors. And so there's no mystery really about the things that have been holding back potential growth. It is the obvious things like not being able to build, the impact of Brexit on trade, skill shortages. These are well known. I think the real challenge is getting that coordination across all of the different bits of government, national and local, and the private sector, who need to coordinate to unlock that potential that you're just talking about.
Dan, thanks for spending some time with us this morning. It's going to be fascinating to see what the Chancellor delivers a little bit later on. Dan Corn, the Bennett Professor of Public Policy at the University of Cambridge. 10 a.m. is Rachel Reeves' speech. We're not too far away from that. 2:45, we get a Canadian rate decision. That's going to be fascinating. It is, of course, followed by a Fed rate decision. 7:30 p.m. this evening. This is London time, Jay Powell's press conference. After market, we get Tesla, we get Microsoft, and we get Meta earnings. I'm going to throw in the Champions League just for Anna as well. That's coming up a little bit later. But let's focus on the Fed and figure out what is going to be happening there. What are we really going to get out of this? Eileen Oyemada joins us now. She leads Bloomberg's coverage of FX and rates here in Europe. Expectations for the decision. There aren't really any real expectations for the decision, but what are we going to learn today about what happens maybe in March?
Yeah, exactly. What the market wants to know is how the Fed is looking at the early days of Trump's administration. Obviously, officials and Powell specifically will be very careful in crafting their message because they have to react to actual policy rather than news reports on as much as they moved markets a lot these days. But what we are seeing investors focusing on is whether the Powell will keep the door open for a March rate cut. Currently, markets pricing a 30% chance of that happening. And if he signals any deterioration in the labor market or talks about how inflation really was more benign at the start of the year, that could be seen as from investors as a dovish message.
Yeah, I mean, it's really interesting thinking about how the different central banks are dealing with the new administration in the US. We heard from the Riksbank earlier talking about particular uncertainty about developments abroad, which you can imagine they are perhaps thinking, at least in part, about what's going on in the US. And then I'm just looking at expectations around the Bank of Canada because we expect a rate decision there as well. And they're actually expected to set out to reveal projections of what to expect if Trump imposes the levies that he's talked about on February the 1st. And he only mentioned that because that's not enacted policy either. And yet here we have central banks setting out what they think in detail this is going to do to their economy. And yet it'll be kind of strange if the Fed says almost nothing.
Yeah, absolutely. I think, like you said, each central bank has its own approach to how to deal with the news. The Fed tends to lean on the more careful side, but obviously that will be the main focus point on the presser, and Powell will definitely have to address it. Let's remember the last time in the minutes from the December meeting, we had some hints that policymakers took into account what they expected from Trump's policies in their forecast.
Yeah, so it's sort of like left up to individual policymakers. Exactly. Some include it and some don't. You know,
yes.
just whatever they felt like.
But exactly. If the meetings are dud and the press is a void, doesn't that just leave Trump's posts on X to move the market?
Yeah, absolutely. That's a risk, I think. We expect him to be commenting on it live, so that could happen. I don't think Powell will ignore it completely, but he may craft his message along the lines of, like, we will react to how his policies change the data. We will remain data dependent and keep the door open to changes in their policy, like not committing to a specific path. Pretty much what he has done in December.
Okay, Bloomberg's Aline Oyemada, great to have you with us. Thank you.
ECB tomorrow as well. Let's not forget that. Got a great conversation coming up for you. The Norges Bank Investment Management CEO is going to be joining us very, very shortly. Nikolai Tangen out on surveillance, 12 p.m. noontime London. I think they did 13%. 12-13%. I think it was 13% last year in terms of their rate of return. That's not bad. What does this year look like? More volatile, maybe?
Yes, big holdings in tech, of course, this business. And so, as a result of that, I'm sure they're really interested in what DeepSeek is doing and what it might do to the cost of employing AI and, indeed, what all of these big US corporates in the tech space have to say today when they report earnings.
Yeah, indeed. Well, we await those earnings, but we are looking at ASML holding its gains higher, nearly 11% still, and that is boosting the stock 600 up 0.4% still, the AEX up 1.15%. But, Guy, you keep raining on the parade.
I do. Look at that chart. That chart rains on the parade. Look, there you go. We are still on a 5-day basis.
No more rain required.
In negative territory. It's sunny today out there. We'll just take the sunshine for the time being. Enjoy the rest of the day. It's buckle up day, kind of a day. Lots going on. The Fed firmly in focus. Earnings too. Look at London. We're sunny. This is Bloomberg.